Welcome to the Daily Brief. We'll go over the action in the market for Monday, January 9th, and then we'll see how things look for Tuesday, January 10th. And it looked like we were getting off to a really good start. We had a gap higher right at the open. We were going up and up and up. We went above R1 that I'll show you here in just a minute. But then we hit the 39.50 level. Things exhausted at that point, and then we spent the rest of the day coming down. In fact, on the next slide, I have a video that kind of typifies what happened in Monday's session.
To fear, little children, I will help.
Yeah, that was just about what it was like on Monday. Everything was going up and then came down as the day went on. So let's go back and talk about what happened during the day. We did have a higher open with prices going above R1 at 38.31, and it was looking pretty good. We then ended up hitting resistance up at the 39.50 level, and then we started to fall after that. Prices declined for the rest of the day and got all the way back down to the unchanged level and went slightly negative going into the close. We were down 0.8%, 0.08%. And even though that's not very much, it still goes in the books as a down day. Volume was still above average. So most folks have now returned to start participating in the market again. So we're seeing volume really picking up from what it had been during the holiday season. The technicals, they're still improving, even though we had a bit of a down day, even though we gave up a lot of the gains, which that's negative in and of itself. We'll have to see if that carries through into Tuesday's session. But on a closing basis, on an end of day basis, we're still seeing some slight improvement with our charts, and I'll go through and show those to you. And this all the way, as I've been saying every day, goes back to inflation and interest rates. And this is like a cat and mouse game that the market plays pretty much every day. If something is a little bit more positive, they think, well, maybe interest rates are going to start coming down, or at least the Fed will pause in what they're doing. If something comes out that's more negative, it's like, oh no, the Fed's going to go to town and do whatever they need to do. And so the market needs to tank because of that. Here's the intraday chart showing where we gapped up from Friday's close, looking pretty good, went all the way up to R1 and stalled there for a little bit and then went up to the 39.50 level. And then things seemed to fizzle out at that point. And then we just spent the rest of the day going down, 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 down. This dashed line is the unchanged level. And then we just closed at the low, but not very much into negative territory. But just looking at this, kind of like a big horseshoe. Well, not the lopsided horseshoe, but to have a real strong morning and then a weak afternoon. That's another reason why when I'm doing trend-based strategies, I wait until the close. If you got in near the open, it's like, yeah, everything's going good. We're going up, we're going up, we're going up, and then it fizzles out. Now you're back to your break-even point wherever you got in at, and then by the end of the day, you're probably seeing a loss, and it's like, oh man, that's really discouraging. So that's why I try to do things as close to the close as possible. If I was doing a up trend type of strategy in Monday's session. I wasn't. I just wanted to use that as an illustrative point. What are some comments that we can make? When the S&P hit 39.50, it was up 1.4%. So it was showing a pretty respectable gain. We did have some Fed speak. This is the Atlanta Fed President Bostic, who's not an FOMC voter, said that the Fed is willing to overshoot when it comes to tightening. It's like, yeah, we'd rather err on the caution of tightening too much, and that it should hold the rates at 5% for a long time. And that was taken more as negative. That ended up causing a lot of resistance in the market. And then this current pivot scenario, which developed on Friday after the employment situation report came out, that, okay, all the rest of the report showed that we're still really growing, but there was one little part there with the average hourly earnings that dropped a little bit more than we were expecting. So then here we come again with this new scenario saying that, well, maybe the Fed's going to be able to slow down or pause their interest rate hikes and maybe at some point even start to lower interest rates. See, that's what the market's been doing really for all of 2022. and now feeding over into 2023. It's like every few days something happens and this scenario starts coming out again. It sucks a lot of people into that. And then once the Fed doesn't really say anything to back that up, or there's other information that comes out to negate this scenario, then things start to go back down again, and you have a lot of very frustrated folks. The NASDAQ and the NASDAQ 100, they did outperform, and they were up on the day. Not real gangbusters, 0.63%, 6.64%, little over a 0.5% gain, but they actually outperformed. And the small and mid caps, they ended the day a little bit positive. For the Dow and the S&P ended up declining slightly. The VIX is still acting strange, so we're keeping an eye on that. And I have some charts to show you. And then this whole earnings per share and valuation concern, that's continuing. That's a scenario that the market's developing now. In fact, I'm thinking of taking it out of this list and adding it to our geopolitical events, because we're looking at that not only internally within the US, but the whole globe is kind of going through this whole process right now with global inflation and global economic slowdown, and that could really affect stocks all over the world. The dollar was down and it really declined. We're getting down into the 102 range now with the US dollar index, and interest rates were down. And both of these together usually give some support to stocks. And they were down early in the day, and that is why we were going higher. But then we hit that resistance and then just started going down anyway. On a short-term basis, we still have some stochastics that are overbought, and I'll show you that, and the Stoch RSI. The Williams percent R chart that I showed for Monday's session, that's off now. There was enough of a decline to bring that indicator down. And then we're still looking a little overbought with the CCI based on 14 periods, and I have the chart to show you that. We have all of our yield curves are inverted except the 30 to the 5. This has been going back and forth. Right now they're even. You're getting the same yield on the 30-year bond as you would be getting on a 5-year note. And so they're just, we'll have to see. Is it going to go back to a more normal yield curve, or are we going to go back to being inverted again with the 30 to the 5? That's not as important, at least in my opinion. It's the 10 to the 2 and the 10 to the 3 months that the market really tends to fixate on the most for looking forward to say, okay, as long as these are inverted, that's predicting that there's likely going to be a recession anywhere from 6 months to 2 years in the future. Sentiment is still neutral. We're not showing really extreme positive or negative greed or fear right now. And we had the consumer credit came out, and this is a little bit concerning just on a personal standpoint. It increased by 27.9 billion, a lot more than the 23.5 billion that they had expected. And in difficult economic times, people are spending their savings. They're having to, my goodness, use credit cards just to buy food or just to buy gas. And so the personal debt that people are taking on as a whole is really starting to increase. And that could also put a lot of stress on individuals and their families and just create a more negative backdrop. The last time this came out, it was up 29.2. So it was a little less than last time, but more than what had been expected. Our trend is still positive. The green line is just barely on top with the slight downward day that we saw, but we're still below the moving average, and the ADX is still declining, and we're well below 20. I'm keeping this at mixed to positive now. I could have switched that over to more negative because we gave up 1.4% gains to close down almost unchanged. That's negative in and of itself. But looking at some of our other charts, they're still clicking over more and looking a little bit more positive, but we're also mixed. This could switch back to being negative quite easily. And I'm also keeping our momentum back mixed because we're just in this range that we've been in for some time. We're still at the higher end of this range, but we're still in a range nonetheless. This is a chart that I have been showing, and we're paying attention to this white line, and this is a large part of why stocks are going down. This is the earnings per share. And in early or late spring, early summer in 2022, This is when the earnings per share started to top out, and now it's coming down. This darker line, which might be a little hard to see, it's kind of orange or rust color. These are the profits, and these are also declining as well. Even though the blue line sales, yeah, it's going down, but they're not going down as much as the white line or the orange or brown or rust color line. So that's why we're seeing a lot of headwinds in stocks right now. This is another chart that I have been showing, which you take all the assets for the three big central banks, the Fed, the European Central Bank, and the Bank of Japan. And this is a longer term chart. It goes back all the way to 2008 or so. But these things change a lot slower. And when this blue line has been going up, that adds a lot of support to the markets. That means that the central banks are more friendly. They're adding to their balance sheet, and a lot of that finds its way into the stock market. Well, as the Fed said they were going to do, they were going to start lowering or lessening their balance sheet, and other central banks are doing that as well. So we're seeing this blue line start to come down, and then the red line here is the S&P 500, and it's been going more in tandem with what the Fed has said they were going to do. We're also seeing, if we're going to stick with this model, this is still, it hasn't been updated in over a week now. I couldn't find an updated chart, but the yellow area here is 2006 through 2008, and it just shows if we stick with this model, there could be weakness going forward here. The white line is where the S&P was as of about a week ago, and we're pretty much at the same level right now as we've been bouncing around sideways. I took the VIX chart that I've been showing off because it's just not matching up anymore. This is the VIX chart that I have been looking at, where we have the correlation between the VIX and the S&P 500. This is still spiking up and getting to kind of a high level. It's starting to come down slightly. And again, as I usually say, look at these red lines. Now, this can just mean a change in trend, but if we look at what the red lines were doing here, sometimes it gave a little bit of support to the market, but what I'm seeing in a lot of these lines is that that usually marks some kind of a top followed by weakness in the S&P 500, because this is kind of acting as an inverse of the VIX, where I shouldn't say that, it's going in tandem with the VIX. When this is really high, that means that fear is really increasing. See, I have the word nervous right here. So when we're really going up, even though we're not seeing that in the VIX, we are seeing it in this correlation, and that sometimes can really suggest that we might see some more fear coming into the market. The Ulcer Index is dropping down. It's more on the positive side. It's not really in the neutral area. If it was neutral, we would be right at the red line where we had been showing more fear. That has really been declining, according to this indicator, as the market has been dropping sideways. The equity put call ratio, we're still keeping a close eye on that. It did go up a little bit in Monday's session because we had a lot of declining that happened for most of the afternoon. And here's the 5 period. We're still seeing, is this a valid spike? But as I constantly warn, usually when we see a spike like this, we see a downward spike in price for the S&P 500, and that's more of a capitulation or a critical mass type of event. Well, when we saw this spike right here, we were chopping sideways before that, and we've been chopping sideways after that. So we want to be really careful using this as a signal that the market could shoot higher. Then this is just a longer term look at this chart. And even though this moving average of the equity put call ratio is coming down, it's still above this red line. And this is usually the line where we say, okay, when it goes above this red line, this indicator is starting to spike. Well, we haven't even got back down below the spike area yet. This is another chart, and I got this from Dan Bird, which every week he sends out an email, and you can get on that. There's a link to his email address, and all you have to do is send him an email and say, please put me on your list. It is in the description below this video, both on YouTube and on Rumble. This is taken from the Stock Market Almanac, which a lot of people really like that book. I'm sometimes I find it useful and other times I don't. Well, he's added some annotations here, and This just takes the number of trading days. This came out over the weekend, so that's why I have a red circle here, because Tuesday will be the sixth trading day of 2023. And then you look at, okay, what did the averages end up doing? Where the NASDAQ usually does pretty well, it tends to do fairly well in the first few trading days. And then the S&P is the green line, and it's just about on top of the, what is that purple one there? That's the Russell 1000, which is also big, large cap growth. And they tend to hold up fairly well. And so we just look at this because there's always exceptions to the rule. This is just saying what happens on an average basis over a period of time. And so this might suggest that we could see a little bit of upward movement with the S&P 500 based on historical trends, realizing that anything can happen. And then what he's done on this chart too is he's added, this is when the CPI report comes out, that's a biggie. This is options expiration. And then there's some other events here that seem to be covered by the key here. I'm just testing this out and seeing if this is useful, if you can pause this and look at it. There's some resources that I'm looking at that I might include in the daily videos and then in the other parts of the program that I have, just that might give us a little bit more historical information to work from. And this is one of those charts. As far as our trend, we shot up, which was going against the negative trend. And now we did have a down day on Monday. So the ADX continues to weaken and it's below the moving average. So this suggests that we're still in a trendless environment. However, it's showing a bit of improvement as the green line is going up with the red line going down. I also wanted to show the double and triple exponential moving averages, the 50 period, because we were finally able to get back above this anchored moving average going back to the COVID low. And so far we've been staying above that. Can we build on that and keep going higher, or are we going to lose this support and drop down below this moving average again? So it's another level to keep an eye on, and that's at about the 3861 level currently for this anchored moving average. Then the vortex, this is starting to cross over positive right now. The green line is going above the red line. It had been negative for some time, so this is showing some improvement as well. And we're still holding up with our Ichimoku support level right here in between the red and the green cloud. Can we bounce up off of that? If we start coming down at around the 3800 level and then close below that, we could end up losing that support, or are we just going to keep chopping sideways overall? The Stochc RSI is still giving us an extreme positive reading, even with the slight down day. The Williams percent R, it's not on our list anymore. It had been giving us an extreme positive reading, but with the down day, it's now dropped down slightly. So now this is an official overbought signal. But as I usually say, these are very touchy indicators and they can give you a lot of false signals, and they can stay pegged either positive or negative for a long period of time. The CCI 14 is still extreme negative and starting to shoot up. With the CCI 20, it's more neutral. It's down around the midpoint currently. The parabolic SAR, stop and reverse system, still has the dots on the bottom, so that's positive. And then I've tried to revamp the oscillators. I've added an oscillator on here, the PPO, and I'm trying to rearrange them from short term. Those are the two top oscillators. And then we have the MACD, the PMO, and the PPO, which is a new one on here. I used to have a separate chart of that. With stock charts, they only let you put so many indicators on any given chart. Well, they changed that recently, so you can add more than what you were allowed to add before. So I like having them all in one place. And then our longer term oscillators are the TSI and the KST. And so our shorter term oscillators are showing some improvement and crossing over positive. We're seeing, and this was one of the technical alerts that was triggered in Friday's session. We had a MACD crossover positive. So that's one intermediate term indicator that's looking better. The PMO is showing some improvement, and I have another chart of that one. And the PPO is also looking a bit better. where our longer term oscillators are showing improvement but have not crossed over positive. Here is the PMO showing how it is going up. And the nice thing about this particular study is based on price and volume, we saw the cross a few days before. And if we still have some upward movement in the market, this gave us a heads up a few days before the PMO actually turned over positive. The BPI has got back above 50, so that's more positive right now. Not really dealing with this topping pattern, thinking that we topped out right here and then we're really going to tank after that. We're kind of negating that as this has been clawing its way back up and then getting above 50. The stochastic in the short term, it gave us an extreme positive reading. That has now been worked off. The intermediate term is showing improvement, and the longer term stochastic is also showing improvement. And on a daily chart, we closed just a little bit below the pivot. But this support so far is holding, and this blue line right here is the 50-period moving average. We were trading above it earlier in the day, only to come right back down and then lose it going into the close. The Swindlin Trading Oscillator also was giving us a little bit of a positive heads up before we saw this little upward movement, and it's still looking positive based on price and volume. Our moving average tree, we were able to slice through a lot of these moving averages, and especially the 50-period simple moving average, but then we came back down below that going into the close. The summation index based on price is continuing to show an advance. It's above zero and advancing. The volume turned up a few days before the price did. It is showing improvement, but we're still below the zero line. And then the new highs, new lows, when we saw the breakout earlier on in the session, that helped to show a lot of new highs being registered and not an awful lot of new lows. So our 5-period measure of this internal strength of the S&P 500 is showing improvement, both with the 5-day and the 10-day. The Elder Impulse system is still green, even though we closed down slightly. And then with our short-term fib levels, we were getting above this one fib level at a 50% retracement going back from the August high to the October low. Well, we ended up losing that, but we're still above this other fib level going from the September high down to the October low. We're kind of right in between support right now in our short-term fib retracement levels. Longer term, we're still above this double Fibonacci level, going back from the COVID low to the all-time high, and then a significant low set back in 2020 to the all-time high. So if we continue to go up, we might bump into this upper end at around the 40-20 level. If we continue to fall, that'll be down around the 3,800 level, 3,810 or so. Now, please be reminded that I eyeball these. Even though there's a tool that I can use to draw them, I have to eyeball the high and the low in all of these. And so between that and the thickness of the line, it doesn't mean that these are exact numbers. We're seeing a Copic curve generating a buy signal. The one warning sign with this is the Copic curve tends to give a stronger signal when it goes down a lot deeper than where it's been right now. But nonetheless, it's crossing back above this red line, and that potentially could give us an upward movement signal. The Pring bottom fisher, this is another one that's very good at finding bottoms in the market. It's getting ready to cross over, but also it's not really getting down to a real low level. When we see more powerful signals here are generally when especially the one that we got back in early October, we were going down extreme negative, we crossed over, and then again, this is as good as it gets, or as good as it got in 2022. This was the advance that we saw going up out of that. If we turn and cross above this, which it looks like it's going to do, that will give us a buy signal, but because it's not coming from an extreme negative stance, it may not be as powerful. But then there's other times when we got a little higher reading here, and this ended up being the June into July strength that we saw going back into 2022. So it doesn't mean that just because it didn't drop down really low that it's not going to give a good signal. There's other times when this gives a signal and it's almost useless. So We just want to be aware of this. We did have a couple of X's that were drawn earlier in the session, and right now, and it's a little hard for me to see this, this is a potentially a low pole reversal with the two green X's that were drawn in. So that's some improvement on the chart. But with the Zoom that I'm using to record this, I have a whole tool chest that just kind of shows up, and I can't really make it go away. Let me see if I can move that. Hey, I can. What do you know? It's a low pole reversal that was generated in Monday's session. And I don't think this gets picked up when I record this. And then another thing that we're watching is we spiked with the staples to the S&P 500 ratio, and it's been coming down. We don't really know for sure, that we'll only really know this in hindsight. But when we take this signal and some other signals, and if we can see some follow through with price, we might have a chance at things turning more positive, but they're still negative overall. The mid caps are still working off a recent golden cross, and they're above the pivot, and they were up 0.02% on Monday, where the Dow was down a third of a percent in Monday's session, but it's still above this pivot level, and then having given us a recent golden cross. And then treasury yields were really down across the board, except for the 3 months. This one is still, it just amazes me that you can plop down your money for 3 months and get a lot higher return than plopping down your money and tying it up for 30 years. That's really interesting how that works. So what's our outlook then for Tuesday? The technicals, this has not really changed from Monday's video. It's negative, but it's starting to turn positive, but we're going to have to see follow through buying, not only intraday, but on a closing basis. If we don't see that, we're going to negate a lot of the positive things that are starting to develop right now. We have a speech coming out at 9 a.m. Eastern time. Fed Chair Powell will be giving that speech, and believe me, it's going to be, if you watch any of the financial channels, if you can tune into YouTube, anything, you might want to consider watching him give that speech, and they're going to be hanging on his every word. As far as the economic reports, we have the NFIB Small Business Optimism Survey that will be coming out, as well as wholesale inventories, and then all the list of geopolitical events. And as I said, the earnings per share, I might add it to this list going in here, because it seems to be a continual thing that the market's really fixated on. The inflation and interest rates are still the big concern, but we want to be mindful of all these other things on this list, because they could come into the picture at any given time and have either a positive or negative effect on the market. So our scenarios can't go with the downwind yet, because the technicals, yeah, they're negative, but we're starting to see more positive signs right now. Can't really go with the up one, not only because we're not trending, but the technicals are still negative overall. Our scenarios and our rotation and our setups, if you're interested in that, I started posting a new video. I recorded it on Monday, and it's all the charts that I don't talk about in the daily videos, the weekly videos, and the intermarket analysis video. And I'm going to try doing that just to give you an idea of what these charts are looking like, even though I don't talk about them. It's kind of the rest of the chart, just to give you some updates. But until things really show some conviction one way or the other, none of these scenarios, rotation, or setups are really telling us much currently. And our technicals are still negative overall. We're trying to regain some moving averages. It looked like we were going to get back above the 50, only to lose that going into the close. The fib retracements are still hanging in there, and then other support or resistance levels. So we're still going with the sideways because the ADX continues to get weaker. It's below 20, but the green line is on top. So we're defaulting more to the positive side now. So our conclusion, the S&P is negative, but right now it looks like it could be improving, even though we gave up a lot of those gains that we saw earlier in Monday's session. The short term is negative, but starting to turn more positive. We still have a couple of indicators that are extreme positive, or we could say short term overbought. We're still negative in the intermediate term, but showing some improvement there. Long term, we're still negative because we consistently remain camped below the 200-day simple moving average. Thank you. I hope this was informative, and please look for that other video that I posted on Monday if you find that will be helpful for you. And have a great day, and I'll talk to you in the next video.